I want to get to the heart of it. The book that I was reading the last few weeks and enjoyed very much, The Ownership Dividend. When I was reading it, I was thinking to myself that dividend-free investing defies the laws of nature and human behavior, which was something that you're getting at.
It's an unnatural state, as my friend Bogomil Baranovsky said. That's an unnatural state. It's so NASDAQ has matured. You say your company is a great success, but you have zero cash flow. That's not a success in my book. The dividends fell into the background. They're declining interest rates. They're no longer declining. You have NASDAQ, tremendously productive, but now mature. You have buybacks, really interesting concept, but now at $1 trillion, you have to ask if it's too much. And finally, the geopolitical paradigm, neoliberalism, that has crashed and burned, obviously, in the last 5 years in a spectacular way. So that all of the conditions behind what led to that unnatural state have either stopped, reversed, or are matured, so that you have to ask, okay, when is the return of the cash nexus? And that's the argument in the book, that we have reached a turning point, a pivot. From my perspective, looking forward, but via the past, the likely return of the cash nexus, where investors would expect a cash return on their investment.
Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest topic of all, money. How to make it, save it, keep it. But our conversations lead us to an even bigger question, what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogomil Baranovsky, author, TEDx speaker, and investment advisor to wealth creators with patient capital and an infinite investment horizon. I work with families and individuals who aspire to grow wealth over a lifetime and generations through disciplined, thoughtful investments in durable quality businesses, while giving money meaning. Join me on this quest to unearth and share the wisdom of the ages. Let me share with you the podcast program disclosure statement. Blue Infinitas Capital LLC is a registered investment advisor, and the opinions expressed by the firm's employees and podcast guests on this show are their own and do not reflect the opinions of Blue Infinitas Capital. All the statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. The information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. None of what you're about to hear is investment advice. My guest today is Daniel Peris. He is a historian, investor, acclaimed author, and senior portfolio manager at Federated, whose unique journey from Soviet Union's archives to Wall Street has fueled his reinvention of dividend investing and his relentless pursuit of historical perspective in modern finance. Dan, how are you? So nice to see you.
Bogomil, thank you for having me on the show. And my gosh, thank you for a really nice introduction. I might have to borrow that. That was well crafted, I have to say. Makes me sound better than I am. Thank you.
First of all, it's all true and it's all yours to use, so I'm happy to share it. Then I read your book and I've been reading your writing and I want to talk all about it, but I want to start with you. And you might know that I asked my guests about the early days. I'm very curious about your childhood upbringing and how you think that time shaped you, your interests, your career, and maybe even your relationship with money.
Good question. I don't know whether the audience will find that particularly interesting, but I did have an atypical career for someone who ended up in investment management. I grew up in the suburbs in the 1970s, headed off to university in 1982. I, for whatever reason, got the Cold War bug. I was very interested in the Cold War in high school. And I, unlike my peers who were perhaps smarter than me, I enrolled in Russian 101 freshman year, met 5 days a week at 8 a.m. I quickly learned that very few other people took that class for that purpose. And I went down a rabbit hole of Russian studies that lasted about a decade, 15 years. Ended up getting a PhD in Russian history. Just place is incredibly fascinating. It remains incredibly fascinating. But as you will have also noted from current news, it's also kind of a dark and difficult place. And what was fascinating when I was 18 was just dark and heavy by the time I was 30, with a Russian wife, a book in Russian, fluent Russian, and a self-avowed specialist in Russian studies. And so at a certain point, also by the mid-1990s, Russian studies had sort of suffered a real deep decline. It had been the privileged child of Cold War studies and government funding for decades. In the 1990s, that all went away when the apparent threat of Russia disappeared, and money and enrollments, student enrollments and faculty lines all shifted to other critical areas. So I moved on as well and remade myself into a financial analyst. But I have always retained the identity of a historian and approach investment challenges from a historical perspective, trying to figure out, okay, where did these rules come from? Where did, say, the CFA rules? Where did your MBA rules come from? Mm-hmm. What purpose, where did they come from? What problem did they solve? What purpose did they serve when they were created? And most importantly, are they still fit for purpose? And that is exactly where a lot of my work ends up, is trying to answer that. Are they still fit for purpose? I am at this point in my life now that Russia is, shall we say, back, also writing on and keeping close eyes there and sharing my views. We'll take that up on another occasion. But that's how I ended up here.
It's interesting because I was born in Poland in 1980, and I got to see the last decade of a political, economic, and social experiment you call the Cold War. I was just born on the cooler side of that wall. Mm-hmm. And I got to see Poland transform. And by early 90s, I watched on TV when Soviet tanks were leaving Poland for the first time since the 1940s, when the World War II came to an end. So it was a fascinating period. The stock market reopened. Businesses were flourishing. Poland was changing so rapidly. I feel like we had 200 years of economic history packed in one decade, catching up with the world. Poland was in a frozen state for so long. And I was just fascinated with business, and eventually investing came to New York, and I'm managing money for wealthy individuals these days. But it's fascinating how our paths overlap in a certain way, and I think we both have great appreciation for history. So I'm curious about this historical training. How does that influence your approach to markets today?
Yeah, I just think it's how I'm wired, in the same way that a move fast and break something person, a younger person, is wired that way. And I've been thinking about innovation, financial innovation recently, working on another piece, and different approaches to financial. I look backward to see sources of financial innovation, even for current problems. Let's talk about decentralized ledgers. They're currently on the internet known as blockchains, but they're really just decentralized ledgers. And you could have instantaneous settlement of transactions with vendors and customers using a medium of exchange between those vendors, customers, and the company. You might even call it a stable coin. But all of these mechanisms, almost all of these mechanisms, have antecedents in the past. And so one kind of counterintuitive approach to innovation is hit the history books. Will Getzman's is a history professor at Yale, finance professor at Yale, and he's written a couple pretty dense, long works on, everything the Sumerians were doing. And, Goldman Sachs does it faster, maybe does it better, but basically they're doing what the Sumerians were doing a couple thousand years ago. And derivative contracts, all sorts of exchange structures, et cetera. And so it's not that there's nothing new under the sun, et cetera. There is room for genuine innovation, But just the way I'm wired to look at a solution to a problem, including an innovative solution to a problem, is to look backward. If you're going to be a plumber, it can't hurt, and it probably is going to help to know the history of plumbing. If you're going to be a brain surgeon, it can't hurt, and it's probably going to help to be to know the history of brain surgery, and so forth and so on. And so I, arriving in the financial services industry, took that notion to heart and said, okay, I've ended up I've left academia, I've left Soviet studies, Russian studies. I'm doing research and writing on investments and finance. I'm going to go back and try to understand current problems through a historical lens to help me solve those problems. And that method has worked really well for me and hopefully for our clients. It does appear, to be looking backward. It is to some extent looking backward. But again, I find the solutions to a lot of current problems, or earlier versions of solutions to a lot of current problems, in history, whether it's the rise and fall of currencies, decentralized ledgers, centralized banks, et cetera. So all the topics du jour, tariffs, whatever the case may be, or basic investment types, where as a minority shareholder in a company, you would expect a tangible cash return for your investment as a nice balancing mechanism, managing an agency cost. Again, 1,000 years ago, they didn't use the term agency cost, but there was an agency cost 1,000 years ago. Now we have a fancy term for it. But as minority investors, we balance our agency costs with cash. And to me, they call it a dividend. So real old-fashioned, apparently. I think it's in a way part of the innovation of the democratization of investment, is you can have in the 20th century, did have in the 20th century, 21st century, the democratization of investment. Well, getting a cash payment is a way to kind of balance things out a little bit when you are no longer, or not the CEO, or don't control the business. It allows me and clients to invest in Coca-Cola without having to run the company, serve on the board. They should vote your proxies all the time, or drive the trucks, or come up with the next great flavor. And so it's just, I think there are plenty of instances. Human variety is substantial in the past, and there are lots of lessons to be learned from how individuals have made, again, what academic finance refers to, decision-making under conditions of uncertainty. That's the modern term for it. Thank you, University of Chicago. But humans have been working on that for 5,000 years. It's not the 22-year-old in their or 20-year-old or the 18-year-old in their parents' house or in their dorm room. They're going to come up with a new way of doing that, but they're not coming up with really new solutions. The problem and the solution, most of them, maybe not all of them, are available for observation, whether it's recent history or ancient history. And so that has turned out to be a fruitful approach to financial innovation for me, and I think for others as well who are wired the same way in a pretty conservative bent.
When I'm listening to you, I'm thinking of mistakes. We all make mistakes, and the one lesson that I learned was that it's cheaper to learn from other people's mistakes. And to me, I'm not saying it's easier.
Yeah, you learn. Yeah, you do remember the mistakes more when you make them, but it can't hurt to review the mistakes of prior generations.
Of course, and I think the point you're making, that history will give us some guidance about the future, but a big part of it is, as a species, we've made a lot of mistakes. And reading history books, it's a chance for us to maybe not make some of them.
Yeah, it's a little bit of humility. The issue with the University of Chicago is the utter absence of humility, meaning whether it's rational actor theory, equilibrium economics. I'd like to poke fun at the University of Chicago. It's not all the University of Chicago. It's mostly, but not all. Equilibrium economics, macroeconomics, rational actor theory, finance as it's in the Merton Miller format, it doesn't comport really well with human beings. And the pendulum swings back and forth between the University of Chicago and the humans. And I'm at one end of that spectrum and the University of Chicago's at the other. And, it's fine. What's interesting, after having been as an asset manager with a very distinct style for a couple decades, is that there is a selection effect that individuals who want this type of investment find this type of investment. Individuals who don't want this type of investment are not forced to invest in this style. Everyone can choose in their own way. And again, that is maybe somewhat at odds with the equilibrium theory or expectations, where everyone's just trying to maximize relative risk-adjusted relative return, which I've yet to meet someone who's trying to maximize risk-adjusted relative return. I'm sure they're out there somewhere in Hyde Park, but that academic description of reality just doesn't comport with reality, and there 5,000 years of financial history to show that.
That's a great point, and I want to get to the heart of it. The book that I was reading the last few weeks and enjoyed very much, The Ownership Dividend. When I was reading it, I was thinking to myself that dividend-free investing defies the laws of nature and human behavior, which was something that you're getting at. Let's call it what it is, but that's how I see it. But over the last century, just observing and reading your book, dividend-paying companies, and you mentioned in the book, dropped from 90% of the total to 30-40% of the market. But that's not the entire story. The yields collapsed to a fraction of what they used to be, to the point that most people don't even imagine or expect a dividend-paying stock to pay anything closer to the treasury bill, short-term treasury bill. But anyways, massive transformation, fundamentally unnatural. What happened? Why it matters? Why are you spending so much of your time and attention on it? Tell us more.
Yeah, I'm zigging while everyone else is zagging, and we're still in the middle of the zag. But the idea behind the zag, where'd the money go, is that as I articulate in the book, there are three very good reasons why the money went away, why investing was made into a cash-free experience. And as you point out, it's kind of an unnatural state of affairs. I like that. It's nice and extreme. It's a great talking point. I will just point out that there were historical reasons why it went away. The first is the decline of interest rates. 40 years, that's 2 generations of investors and financial professionals. That's time for the CFA curriculum. That's time for the University of Chicago curriculum. It's time for Goldman Sachs to create lots of products. It's time for the world of debt-financed finance to just leap ahead. For private, unofficial opinion, private equity is simply a product of declining interest rates. It would be very hard to have strip and flip private equity the way we had it if you did not have 40 years of declining interest rates, and so forth and so on. So those were legit. The hurdle kept on getting lower and lower. What's interesting again is when you are coming into the industry and you see, well, interest rates are low and this is acceptable, et cetera. Where did the interest rates come from, and are they likely to remain low? And we did have a bottom in interest rates. Interest rates stopped going down for whatever reason, stopped going down. September, the 10 years, the interest rate that matters to me as a standard equity investor, in September of 2020 and August, September of 2020. And, we're probably not going back to those levels. Interest rates have stopped going down. So that's why, reason number one why I think people should, okay, let's question what we've done the last 40 years. Maybe we agree with it. Maybe we're going to stick with it. Or maybe we are going to ask whether certain things will change because something so important like interest rates were trending in one direction for a very, very long period of time. The second reason, I have to acknowledge the significance of it, is, the wonderful productivity in the technology space that is largely coincidental with the decline of interest rates from the 80s through to the present time. And we'll still seeing now there's a great deal being bet on the productivity of AI. If it doesn't show up, a lot of monies will have been wasted. But if it does, then it's justifies itself. So those companies started as burning cash, as any startup venture would, and they grew to prodigious size, as any successful business would. But there again, after 40 years, a company with trillions of dollars in value, I'm not making the number up, hundreds of billions of dollars in revenue, tens of billions of dollars in profits, and it doesn't pay a dividend to a minority shareholder. It's an unnatural state, as my friend Bogomil Baranovsky said. That's an unnatural state. It's time. So NASDAQ has matured. NASDAQ has matured. Now, an arms race is broken out among 4 of the big NASDAQ companies, and they would claim, no, actually, we're spending a lot of money on some stuff right now. We're busy right now. We can't do it. But for the rest of NASDAQ, they can either afford or can't afford a dividend. It's a real measure of success. You say your company is a great success, but you have zero cash flow. That's not a success in my book. So that was another reason why I think dividends fell into the background. Third reason is a rise of buybacks. Really, really good on Wall Street. Don't have much of an impact on Main Street, but as Charlie Munger and Warren Buffett and Paul Samuelson and many others quoted that, show me what your incentives are and I'll tell you what the behavior is. And when you gave Wall Street buybacks, they were going to use buybacks. So corporate America has really gone down that rabbit hole. Trillion dollars in buybacks this year. Fourth reason, political. We can get back to it. It's the global neoliberalism that emerged roughly the time when you were born, Bogomil. Margaret Thatcher, 1979, Ronald Reagan, 1980. Deng Xiaoping, 1979, and global neoliberalism goes on a tear for 40 years from the early 80s, and that also meant outsource, low cost, invest abroad, etc. Focus on financial returns rather than cash returns. It all contributed, all part of the same thing. So declining interest rates, they're no longer declining. You have NASDAQ, tremendously productive, but now mature. You have buybacks, really interesting concept, but now at $1 trillion, you have to ask if it's too much. And finally, the geopolitical paradigm, neoliberalism, that has crashed and burned, obviously, in the last 5 years in a spectacular way. Mm-hmm. So that all of the conditions behind what led to that unnatural state have either stopped, reversed, or are matured, so that you have to ask, okay, when is the return of the cash nexus? And that's the argument in the book, that we have reached a turning point, a pivot in a broader political economy. Interest rates no longer going down. Tech companies are mature. Buybacks are controversial and too large. And the geopolitics are no longer favorable. That I think that more investors over time will be insisting as minority investors, again, with facing significant agency costs. Agency costs for your listeners, meaning not the cash cost, but the soft cost of no longer running the business and of delegating the management of the business to other people who may not view the world exactly the way you do. You may like the Coca-Cola company, you may like their products, but the truth is you're not on the board, you're not running the company, mm-hmm. and they're going to do things a little bit differently than you. That's an agency cost. So all of these factors, I think, are going to challenge a paradigm that was pretty significant and strong, deeply rooted over the last 4 decades. And from my perspective, looking forward, but via the past, the likely return of the cash nexus, where investors would expect a cash return on their investment.
Before I ask you about this moment that we have, which I would call, show me the money, I want to highlight what's in the book, and you talk about it a lot. The fact that for 60 years, academic finance has dismissed dividends as irrelevant, with some of prominent names predicting that they would vanish entirely. And here we are, you could say that there was a war on dividends. Maybe there was even a war on savers, separate topic. Yet here we are, we're still talking about dividends. We still have dividend-paying stocks, and I'll come back to it later in the conversation. But some of the Magnificent Eight, with the exception, I think, of 2, actually started paying dividends. So we have not eradicated dividends. Why not?
Yeah, I did a post. Spencer Jacob of the Wall Street Journal did a little column a week or 2 ago about "I'm not dead yet," basically, to the dividends. And he did a nice little thing. They haven't really gone away. They were supposed to go away. They didn't go away. And I did a 3 or 4 line intro to as I distributed his piece, saying, academics have been hectoring against dividends now for 60 years. And yet they haven't gone away. Maybe they've been arguing that dividends are irrelevant. Well, after 60 years, if they're still making the same argument, and the dividends haven't gone away. Maybe it's the dividend irrelevance theorem that needs to be reviewed, not investor behavior. And so that's the answer. The 2 chapters on academic finance in the book were the most enjoyable to write. One's for, one's against. I just split up the antis and the pros. They are largely unreadable, except to people like you. So if you're a retail investor, doctor, lawyer, or looking at this interested, just skip those 2 chapters. One highlights all the academics who were in favor. The other highlights all the academics who were against. The academics who were against, much higher profiles, collected lots and lots of Nobel Prizes, and were in the foreground. The academics who were for were in the background, very strong people. John Lintner, no slouch, certainly. But the other academics in favor, maybe slightly less high profiles. But that was great fun to read. It's an academic food fight, but not quite, a little bit, Animal House, the food fight scene for academics. But it's largely unreadable. But the reality remains, if you keep telling somebody something for 60 years and they're choosing not to listen to it, you have to, after a certain point, you have to ask, well, maybe my advice isn't all that good. And that's, part of the reason I make fun of the University of Chicago et al. Is that academic finance, I think, got this one really, really well. Why? Because of their physics envy, because of their notion of systems in equilibrium, and a underappreciation of human behavior. And so that really has been the business opportunity of being a dividend investor in a non-business environment. You're doing exactly what the CFA Society says, Institute says don't do, and the MBA curriculum say don't do, and what any sober, coherent, successful business person would do. And that's where this has ended up.
I want to talk about the business outcomes and market outcomes, which rhymes with what you just shared. I'd love for us to go back in time a little bit and explain to us, why would anybody become a shareholder, and especially a minority shareholder in the business, if not for some sort of promise of dividends or cash return at some point? I think that's such an obvious truth that it almost got forgotten, at least from the books I was exposed to.
Yeah, and it's understandable, again, particularly in the last 40 years, how we got there. But it's worth, thank you, Bogomil, for asking the question. This was articulated that you can't really, unless you're a pure speculator, you can't really make a sober business investment unless you expect there's a cash flow that adds up to whatever you're paying for the business. Even if you're selling it tomorrow, the person who's buying it from you tomorrow has to do the same calculation. So Irving Fisher in 1906, John Burr Williams in 1938, John Maynard Keynes in 1936, Benjamin Graham in 1934. They're all writing about, this is pretty simple math. You pay for an asset, the cash flow that you would get from it. The working out of the cash flow actually is a non-trivial task. John Burr Williams spent 500 pages doing it. And, there's a lot of academic work on how you actually do the cash flows. But if it doesn't add up to the cash flow, even if you're just selling it tomorrow, somewhere along the line, someone who is buying it, if they're buying it with any serious intent, or is doing the cash flow analysis. Otherwise, no assets would be there. And it's cash flow that you receive. Otherwise, again, there's no point to it. So that's the standard framework that I, as a historian, encountered. It kind of makes sense to me. It's been observed for the last 5,000 years. Where did the cash go in investor psychology over the last 30 or 40 years? Because this environment of, or expectation that, as a minority shareholder, you would expect a tangible return on your investment is reasonable, but it's really dissipated. And now investors are perfectly content to have what I refer to as contingent returns, not actual returns. I think there are two real reasons, and they're both very interesting. And I've been told to my face, the reaction to the book by more than a handful of journalists and practitioners has been negative, which is really interesting. It's a topic for another day. And they make 2 points. First, in a market that's always going up, you can harvest the capital gains. And so as long as the market's going up, you can time the capital gains. dividend payments come on a regular schedule, which is nice if you want it. But if you don't want them for whatever reason, you can time it. And if you don't need the money now, even though it's a great agency management tool, even as an agency management tool, you could reinvest the dividends. But let's say you don't care about agency and you don't want to deal with reinvestment, just leave the money with management and let them, everything goes up. Everything goes up and to the right. Everything works out like NVIDIA. So that number one argument the last couple decades has been, according to academic theory, a harvested capital gain and a dividend payment are identical. That drives me nuts. It is so wrong. But empirically, you can make that argument and not be judged crazy, because over the last couple decades, everything's gone up to the right, and most investors over most of the time, if they don't make serious mistakes, will benefit from capital gains. And the market's open 5 days a week. It's mostly liquid between 3:45 and 4 p.m. and they can generally get a reasonable price and so forth and so on, so that the necessity of getting the dividend payment has been diminished in an environment of preferred capital gains or easy access to capital gains in a highly liquid market. I can't dispute that alternative approach to managing, say, cash flows or an investment or agency costs. It's out there, and it's been very popular the last couple of decades. I have lots of clients I know who, for a variety of reasons, literally prefer, even though they're taking distributions, they will still reinvest the dividend and then time their distributions exactly the way they want them from the portfolio, sell shares. So that's one option. The other, similar and related to that, is some people really, 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 really don't want to pay taxes, even a de minimis amount of taxes. And even though the tax rate on capital gains, long-term capital gains and qualified dividends is exactly the same. People, let me say that again. Tax rate's the same. The only difference is timing. You have people who build entire investment portfolios around avoiding taxes. There was a product that, I won't mention it, product that was launched last month that invests in ETFs of the S&P 500. It itself is an ETF of the S&P 500, but by investing in ETFs of the S&P 500 and then trading around the X states, manages to avoid a dividend distribution from the S&P 500. Bogomil, you probably know, but I don't know if all the listeners will know what the current yield is on the S&P 500. Anyone want to take a guess? It's fairly low, 1.2%.
There you go.
So to avoid a tax on 1.2% return, someone will bend over backwards, put their heel above their chin, their arm underneath their body, do whatever calisthenics they can to avoid a tax on something that has no income. They're trying to avoid an income tax on essentially no income. They must feel very strongly in order to go to that effort. They're going to pay a bunch of fees to avoid a tax that's de minimis because the yield on the market is so low. That is a choice. Now, academic finance treats it as a tenet, but I would say it's a choice. But those two factors, the desire to avoid any taxation and the ability to have capital gains handy, has, I think, contributed to the other factors that we mentioned earlier as to why investors would kind of put up how have they managed things. Mm-hmm. In the absence of dividends, they've managed them through harvested capital gains, and they have used the opportunity of a low-income environment to even avoid any taxation at all. I do make a point in my writing that the subordination of investment policy to tax minimization is a choice. It is not a maxim of modern finance, but it feels like a maxim because so much of the industry is built around. You work in you said private office or family office. I'm willing to guess that a good bit of your time is around tax management. But avoiding tax on a 1% income stream, to me, that's quite an extreme exercise. Maybe your clients will disagree.
manage money for wealthy families who have had wealth for many generations or are looking to have their wealth last multiple generations, and taxes definitely come to play. And there are moments where I feel like, let's focus on the investment approach first, and then the taxes could follow, then the other way around, because if you focus on taxes, some really peculiar outcomes can follow, just as the one that you described, but there are even more unusual things that can come up if you put taxes as the absolute goal of what you're trying to do. But you touch on human psychology, and I think that's where the academics get a bit lost, that we do things that make no sense, and even the fact that we accept that there are no dividends, I think when you really look at it, it makes no sense. But that's how we operate. There is a certain idea in your book that really spoke to me. I think you provided a vocabulary for something that I was trying to explain maybe to myself, to my clients at some point, that when I look at the dividend, it's a business outcome, you call it. The business is doing well, and you can't really fake it, for lack of a better word, for too long. Obviously, some companies even borrow money to pay a dividend. I'm not talking about that. You actually earn the dividend and you pay it from your earnings. And then you have the market outcomes, which is capital gains. When you analyze a business, you and I, people like us in the profession, we look at the fundamentals of the business. The business outcomes are something that really pays in the long run and something we can follow. The market outcomes, it's something that, if we're really honest about it, we don't have control over. We don't know which will be the top 5 best performing stocks in this quarter. I don't know. I don't know if you know, Dan. I don't know. But that's not the goal of what I'm trying to do. I think the big point, I'm curious about your thought, is following the business outcomes. It's a much better North Star here than trying to follow just the market outcomes. What are your thoughts?
Yes, for me and for you. I think that some of this, again, has to do with what modern finance missed, which is personality differences. I sleep better at night following the business outcomes. I sleep better at night having 30 or 40 income streams from well-established businesses growing in line with GDP, nominal GDP over time, maybe a little bit better if I'm good at my job. The returns there are, we've been very fortunate to live at this time in this place where, we're not in medieval Europe with population declining yet. We're not in some catastrophe, though frankly there are plenty of catastrophes out there. But over the last couple of decades, economy's done very well, particularly in North America, and owning these types of assets that I own have generated very nice positive returns, and they're very tangible assets and they're tangible returns. But at the very same time, there are contingent returns, which are frankly higher, in some cases much higher, which are available for those people who sleep at night differently, shall we say, and are wired differently and want risk. Here, the original Markowitz notion of risk and return, there is no efficient frontier, but the original way, and depending on how you define risk, his definition of risk is certainly not mine. But broadly speaking, I'm sympathetic to the idea, which is observe the first time we exited the caves and went, hunting for the saber-toothed tiger or the woolly mammoth, is that there is some correlation of risk and return. And there are plenty of people who are gunslingers and want to sling their guns in the markets. And rather than, for me, even though I consider them unnatural, it's unnatural for me, as the unnatural state, as it were, you described. It's an unnatural state for me to be that gunslinger. It's a pretty natural state for them to be that gunslinger. And so that the type of investment style that you advocate, obviously we're more in agreement than disagreement, but I think it in many ways it comes down to not necessarily right or wrong, it's personality. And those people are, they may be younger. I was kind of born an old soul, so I've been this way for a long time, but they have not an academic definition of risk, but a greater tolerance for we'll just call it a generalized sense of risk, and are willing to speculate, what I call definition of speculation, which is, buying and selling securities that have no intention of ever paying you anything. So you're strictly dependent upon harvested capital gains or losses, because you'll never get a penny out of the business. That's a choice. What I object to is not that choice. It's that over the last several decades, that has come to dominate the U.S. stock market. Prior to the 1980s, that corner of the stock market was a corner of the stock market. It was a portion, whether it's 10%, 20%, 30%, where more speculative nature, move fast, break things, high risk, high return, all the good stuff, but it was a reasonable portion of the market. As a kind of old soul looking at the market now, the risk is that it's 2/3 of the market or 3/4, and that the ability to be dependent upon a business outcome there's plenty of opportunities in the market, but it's not 70 or 80% of the market. It's 30 or 40% of the market, and well more than half the market de facto is limited to speculation share prices, even though there are securities, including some of the technology names that you mentioned earlier, that instituted dividends in the last year or two. The dividends are so de minimis that they can't be part of a investment calculation. So you're basically just entirely dependent upon the share price. So again, how much of the U.S. market should be a casino, and how much should be a business investment platform? What has happened over the last 40 years is the pendulum has swung, the balance has swung from mostly business investment platform with a fair opportunity or measure of speculation to technically, without cash distributions, mostly a speculative platform that is not a judgmental speculative, but technical speculation, meaning you're dependent just on the share price alone, and a relatively smaller percentage of the market is eligible for business investment, where you as a minority owner would be dependent on a business outcome, not a stock market outcome. So, the difference in psychology and wiring and option and freedom is good, is fine. It's a matter of where the pendulum is. And the book, The Ownership Dividend, calls for the pendulum to move a little bit more to the middle over the next couple of years.
Business outcomes coming to the front of the discussion.
Picking up speed and getting greater share of market, shall we say, greater share of the S&P 500.
You touched on so many things, and I want to very quickly, risk, I think to you and I, it's permanent loss of capital. I bought something, it's worth a lot less than I thought. I have to realize the loss, walk away. That's risk to me. I was just wrong about the investment for one reason or the other. And price volatility is not risk. And a lot of academics would disagree with me, but that's how I see the world. End of story. I don't have to get a PhD. That's how I feel. And I think that's for the benefit of this audience to be clear how we look at risk. Losing money, risk. Price moving up and down since yesterday, irrelevant to what I'm trying to do at least. But you talk about the investment style that suits your personality. I do want to highlight that you use the word clarity versus truth, and just finding the way to approach investing that works for you. I think it's very, very important, whether you're investing your own money, you're investing money for other people, you have somebody invest your money for you, finding that alignment, that this is the style that works for you. And I would go as far as forget the benchmarks, forget anything. Does this style work for you? And efficient or not efficient, whatever way the academics would like to describe it, I haven't seen an academic sit down with a client, show them the portfolio, and the portfolio is down 20%, and see what it's actually like to see somebody experience the loss of money or the gain on the investment. And it's outside of any efficient market theory or anything. It's a human experience. Is this the journey you want to be on? Are these the returns you'd be happy with? Everything else stops and it doesn't matter. I do want to ask you about the phenomenon that you've been touching on, and I do want to explore it more. When I'm looking at today's companies, we have a lot of companies that have higher margins and lower capital needs historically, right? So you would think there will be more capital. They actually are creating a lot of free cash flow that they don't need. They're trying to reinvest, but they might not need it the same way Carnegie Steel needed capital to grow. yet the yields are so low and they're paying nothing. What's happening here? Because it looks like it's a perfect setup for us to see exactly what you're describing. The cash is finally going to come back to the shareholder. What's going on?
Yeah, if you do the math, there's about $1 trillion missing of free cash flow. And that $1 trillion has gone to buybacks.
Mm-hmm.
Makes Wall Street wealthy, makes the corporate executives wealthy. It may help shareholders. Remember, buybacks don't directly help shareholders. They provide liquidity to share sellers. Very important difference from my perspective. Academic finance treats a buyback and a dividend as equal and prefers one for a variety of reasons, and therefore claims it should be a irrelevant decision, etc. Buybacks is if the company's doing that well, they could have $1 trillion in buybacks. Now, what's interesting, up until 2-3 years ago, that $1 trillion is free cash flow. Now, with the AI arms race on, it may actually come down a little bit. You may see less than $1 trillion. I will see that play out over the next couple of years, but. These companies have higher margins, better cash flow than the railroads, and yet they don't pay dividends. Think about that. During the 19th and early 20th century, through much of the 20th century, we did a very, very capital-intensive industrial build-out, and companies managed to pay dividends on top of their capital intensity. Now we have software and service companies that have low capital intensity, higher profitability, and they can't afford to pay a dividend. No, they don't want to pay it, and they want to buy back their stock instead. So again, in the academic community, that's a perfectly normal outcome. In the business community, I think that's crazy. So an unnatural state of affairs. But yeah, buybacks are easy for me to pick on. There are certain instances where they make sense. I don't want to be too regimented about that. We do have, the portfolios that I manage, or there are plenty of instances beyond that where you have mature companies with relatively large payouts and maybe cyclical industries. A couple of oil companies are examples. And they should buy back their shares just to manage the dollar value of their dividend not getting too much. There's an oil company, pretty prominent, based in Texas. I suppose they're all based in Texas, said, listen, our dividend, each year we pay out it's billions of dollars a year in dividends. We need to be cautious about that. It's a cyclical industry. We're going to grow the dividend per share, but we're going to do that partially by just reducing the share count religiously year over year, because we don't actually want the aggregate dollar dividend amount to go up too much, because it'd just be too big of a number. We'll get ahead of our skis. And frankly, there are some other companies, a couple, I could argue some phone companies that probably should have adopted that type of approach. So there is a role for it, but where a company comes out and says, we're going to return cash to shareholders, which is semantically untrue, and we're going to reward shareholders, which is semantically and mathematically untrue, and where it's $1 trillion, which is a big number, I do take exception to this equivalence of a buyback and a dividend being returning cash to shareholders. One is a return of cash to shareholders. The other provides liquidity between 3:45 and 4 o'clock to share sellers. They are not the same thing. It's not finance. It's philosophy. They represent different activities. One's a business outcome, the other's a financial outcome.
I have a colleague who is a fellow investor who might be listening. I'm not going to bring out his name, but he knows I'm talking about him. But he has this idea which is parallel to what you're talking about. It doesn't contradict it. But the idea is that if the business has opportunities to reinvest capital at respectable rates back into the business, it almost shouldn't pay a dividend. It should maximize all the opportunities available to them. Obviously, it's easier said than done. A lot of companies follow lower margin and lower return opportunities that they started with and dilute the business. But as long as you have an opportunity, you would expect that business to take all that cash the same way a small business owner would, put it back in the business and double it in size. Wouldn't you do that?
That argument is absolutely valid for small businesses that are growing. Occasionally, I guess, for a large business. The question becomes, at what point? There was an online bookseller They started as an online bookseller. They were very clever as an online bookseller. And they started saying, you know, we can sell things other than online books, but it's going to consume a lot of capital. And they did that for decades. They got really good at it. And in order to sell books and then other stuff, they really needed a lot of computers. And they, once they had all the computers, they realized, you know, we're really good at managing computers. Maybe we should sell computer time to other companies because we're really good at it, because we needed it for the book business. And they got really, really good at that. But that also took a lot of capital intensity. And throughout this whole period, this business went from being relatively small, like a startup business, to hundreds of billions of dollars in revenue. But it never really made much of a profit until 2-3 years ago. And because it was constantly reinvesting, got bigger and bigger and bigger. It never made a sufficient profit to justify a profit distribution to company owners after 20 years. Only thing that made, you know, the share price went up spectacularly, but the business has never been particularly profitable. So yeah, that happens. You can reinvest in perpetuity until you get to perpetuity. That's a choice. If you do that with all of your investment dollars, you're going to lose some, because 99% of those go broke. But if you get the 1% that works, then, you know, it all works out. Again, it's a choice of philosophy. It's a minority shareholder. I understand reinvestment needs. I want the companies to grow. We are not bond investors. We are equity investors. But there is a clutch point where you expect the company, if they're going to be successful, they're going to manifest their success tangibly, and that point needs to be reached at some reasonable time. You know, we don't traditionally, by definition, given the nature of my day job and mandate, invest in startup companies. They don't have dividends. But at a certain point, either a company's successful or it's not. It can be big and not successful. It doesn't have, what's the measure of success? It doesn't have any cash flow. So either a company has cash flow or it doesn't have cash flow. Some companies will get to cash flow in 5 years. Other companies will get to cash flow in 25 years. Other companies apparently will never get to cash flow. So it really depends on, again, as a minority shareholder managing these agency costs, it's the choice that you make. It's philosophy, not finance. But looked at in isolation, your friend's comment is absolutely correct. And if he has 100% of his investments in those types of companies, then he or she is in, you know, Silicon Valley at a venture capital firm. And that's great. It's a very high risk, high return business. But for Main Street, just doesn't work that way. And, you know, for Main Street, there should be the appropriate realization that not everything's going to work out 100%, and that you should keep management's feet to the fire, and you can have a reasonable expectation that either a business will become profitable or it won't be. I don't consider that a slander against growth. I don't know why a company getting to profitability and distributing the profits should be viewed as a slander against managing agency costs.
Mm-hmm. Otherwise, it almost defies gravity in some way. Then let me share with you what I'm worried about. Early on in my career, I got to meet, I've been doing it for 20 years. I got to meet people that were close to retirement. They passed away since, but they were telling me tales of people they worked with that remember the Great Depression. It was a New York experience hearing all kinds of tales and stories. But anyways, many of them told me they're waiting for the single-digit PE. They told me if you wait a bit longer, you're going to see the whole market will be at a single-digit PE. They passed away since. Lovely individuals. I learned a lot of things from them. We never got to the single-digit P, as far as I know, for the market as a whole, and very few stocks these days even trade at those Ps unless they're in real trouble. But do you worry that you and I, and maybe members of this audience, waiting for those dividends to make a real comeback, are we waiting for something that may not happen in the foreseeable future?
Yeah, that's a fair question. And it's a question that Benjamin Graham and to some extent Warren Buffett have asked themselves. If you read, again, history has a lot of solutions about tomorrow. If you read the different editions of security analysis, Benjamin Graham changes. In the first edition, 1934, his expectation of what a stock should trade for is about 10 times. And in subsequent editions, I think the last edition was 1971. In subsequent editions in the 50s and 60s, he says, it's kind of crept up. I don't really have a good reason for why it's crept up. There's growth, et cetera. But without any particular anchor, I'm going to say, the new number's 15 or 18, whatever the number is. And he had to observe that. In the same way, the frog in the boiling water, as a dividend investor, you saw the yield go from 3 or 4% down to 1%. And, it's fine. It may get a little bit worse, but the yield will eventually get, and then it keeps going down and down and down and down. We're not at, but we're near the lows of the stock market's yield of about 1.1%, which was during the internet bubble. And we're pretty close now, 1.2%. And there are some interesting arguments as to why yield PEs are high and yields are low. The growth prospects of the economy. PEs are, in theory, a form of an inverse discounted cash flow. Most people don't view it that way, but it is. And it's the discount rate if you have flat cash flows going forward, and if you invert it, and the interest rates coming down has an impact on the discount rate that you would use. So you could argue that with declining interest rates for 40 years, you would naturally, even if you're a dogmatic cash flow investor, dividend investor, that you would justify higher PEs and frankly lower yields, and so forth. So that there's kind of some math behind why the PE of 10 is a lot less frequent than it used to be. But is gravity ever going to reassert itself? That is a separate question. Gravity will reassert itself. It may not be to a PE of 10 for the market, given the structure, the service nature of the economy, the interest rate structure. The nature of risk has changed. I mean, in prior decades and centuries, when you had much lower PEs, you also had much higher perceived risk. You had very little information about your companies. The agency costs were off the chart. So you could, in theory, insist on a low PE because you just didn't know what was going on. Now we have more liquidity. There's more regulation. Hopefully it's benign. There's somewhat greater transparency. And you could argue that all those justify higher valuations. So I don't know if we're going back to a 5 PE just because nobody trusts each other anymore. There's more of an infrastructure of modern finance that justifies higher PEs. That being said, and maybe even lower cash yields than in history. That being said, having a 1% yield from the U.S. market and a PE of 25 is stretching it. And I do think gravity will reassert itself at a certain point. It has not for really 15 years. So there's no reason to think it's going to do it tomorrow. I'm not saying that in the least, but I do acknowledge that the economy has shifted, and the infrastructure of investment is probably allows for a higher bottom if there were to be a correction, because there's more support there for higher valuations. But I put on social media, I did a survey just a few weeks ago because I was interested in the exact same question. I said, 5 years from now, where do you think the market PE will be? And I had 25, 20, and 15. Only the surveys on social media allow 3 options, and my audience is very conservative, and so I expected a skew towards 15. I just did. And it was very interesting. I got, I don't know, depended on the different platforms I was on, but I got like 20 or 30 different responses on each platform, and they tend to be separate audiences. And they were not skewed at all towards 15. They had almost a normal distribution. It was like a quarter 15, a quarter 25, half 20. So even my conservative audience, now their new normal is a higher PE than your former client's 10. So take that for whatever it's worth, which may not be anything.
I think the expected returns, however you receive them, and as we speak, they won't come mostly from dividends. They will come from appreciation, the expected dividends that people might have going into investing seem to be still very elevated, maybe because of the last few decent years that we've had. I think people might think that the market can deliver, but the math is pretty brutal. You have earnings growth and valuation expansion. You can only expand the valuation to a point, and I think we both know that it's harder and harder to get more and more excited. If anything, I see a lot of skepticism here and there when the growth is not delivered. Separate topic. I do want to
one
ask
thing,
you,
but an important topic, one thing that I think is worth noting there in terms of growth. One thing that's changed over the last 40 years and may support elevated this, that, or the other going forward is we have the difference between nominal returns and real returns.
Very good point. Very good point.
Because of inflation, nominal returns probably going to look pretty good. Nominal S&P 500 earnings probably going to go up. Nominal company earnings, even if you don't own NVIDIA or some tech kinds, probably going to go up. So that nominal earning, that we do operate in nominal dollars. We should think in terms of real and nominal, but all of our measurements of money, as it were, are in nominal dollars. So I think that the balance between the multiple and the earnings, that there's actually for the first time, not for the first time, but for first time recently, in addition to genuine growth, we have a lot of inflation and people disagree about it, but to me it seems like it's likely to stick around for a while, that you could have pretty significant nominal earnings growth. The question then becomes, what multiple do you apply to it? And that's what I was trying to get to in the survey, is that in an inflationary environment, you would be more cautious with your multiple rather than a high multiple. In a low inflationary environment, you can justify a higher multiple from a cash flow perspective. So we shall see. Right now, people seem to be pricing in perfection on both fronts. I agree with the fact that it's likely to see nominal earnings do pretty well. I have a lot of questions as to whether you apply a 20 or 25 multiple to inflation-juiced returns. Personal opinion.
That's a very good point. Then, as I'm listening to you, I'm thinking of another friend who's not based in the US, who is a dividend investor, who's actually a big fan of your writing. I'll mention off the record his name if you're interested, if you two want to talk at some point. But anyways, I'm wondering if our conversation is very US-centric, and if that's the case, have you seen the same anti-dividend phenomenon, for lack of a better way to describe it, unfold globally, or are we looking at it from a very US-centric perspective and the whole world is unaware of what's going on?
Well, they're not unaware of it for sure. All the capital flows for decades into the U.S. It is U.S.-centric, however, intentionally. The anti-dividend bug is mostly a U.S. phenomenon. So now most of the mature markets in the rest of the world almost wish they'd had the anti-dividend bug, because they saw NASDAQ, they saw buybacks, they saw all of the activity associated with that, and I think they probably regret it. England, kind of the home of formal dividend investing, is struggling and really is going through a tough patch. But those companies and most companies in continental Europe continue to reward shareholders, not share sellers, but shareholders with cash. They saw nothing wrong with that. And that makes it, as a dividend investor in the United States, we have portfolios that invest outside the United States for that very reason. At the same time, those managers and many of those companies are looking at the United States and say, why don't we have a NASDAQ? So it's kind of, why don't we have buybacks? Now, buybacks are legal in certain areas. They're illegal in certain other markets. But, they really became a phenomenon in the United States, as did NASDAQ. Those two phenomena are distinctive. And the payout ratio and yields outside the United States are generally higher. The one exception is Japan, but Japan is its own story. And, interest rates have always been lower for a variety of reasons in Switzerland, to some extent in the last 40 years in Germany. So there are, but the notion that you would, as a minority investor in a company, be paid in cash is pretty well developed outside the United States. It's really only the U.S. where they get away with very large, mature, cash flow generative companies not paying dividends.
One or two questions, but I have to ask before. Stock-based compensation. On the surface, it looks like a decent idea because you're making employees owners. But the outcomes are peculiar. And you mentioned buybacks, but one part of buybacks is to offset stock-based compensation. Real quick,
Yeah.
how do you feel about stock-based compensation?
On one hand, I want more employees of large
Yes.
businesses to own stock, dividend-paying stock, not just stock, dividend-paying stock. I've spoken with a number of U.S. corporations, and they say that when we, on this topic, I raise this topic frequently, when we try to issue stock to employees, they're not interested or they just sell it. And I think that that would not be the case if the stock had a material dividend to it. Now, there may be some education involved. Again, over the last 40 years, dividends have been beaten out of pretty much everyone. So it's not reasonable to expect employees to somehow behave differently than everyone else in the investment community. But there are some European companies, one of which I highlight in my social media posts, an international energy company based in France, that touts how much stock it gives to employees, the income associated with that. And that company tends to yield around 5%, so it's material. And I think that's great. I think that aligns the interests of employees and management and investors. Not a perfect alignment. There's no such thing, but it aligns it. There are a couple companies in the U.S., one of which is struggling right now, but there is a company in the U.S. that has a lot of employee share, a brand name company. There's a lot of employee, non-tech company, old economy company. There's a lot of employee ownership, and in theory that should support some sort of alignment. We're all pulling in the same direction. As a practical matter, maybe it doesn't. It may just be in theory, but I still think it's a really good point to make that that option exists out there. In California, stock-based compensation serves a completely different purpose. It's just a way of avoiding paying cash and getting, kind of rich quickly. There's nothing wrong with that. But it's, like from an accounting perspective, it's different. And from because you're really affecting earnings. Fortunately, the accounting rules did change. I forget when the change occurred, but now stock-based compensation is, viewed as an expense, as it should be, at least in some of the accounts. It's funny. My day job in overseeing dividend portfolios, we don't have too many tech companies that do a lot, so I forget exactly where the rules are now. It's been a couple decades since I had to review that, but it certainly should be viewed as an expense. It creates a completely different dynamic if you don't view it as an expense. But the point is that for companies that announce large share buybacks, I think this is where you're going, you have to see whether the actual share count is declining. In the old economy, where I do spend a lot of time, companies that announce buybacks, generally speaking, are reducing their share count, or they're trying to extinguish shares that were issued as part of an acquisition. Separate issue as to whether the acquisition is a good idea or not. But generally, they are reducing the share count. For the tech companies, modern companies, startups, it's a completely different dynamic. Totally different dynamic.
One last question. I have 1,000, but I'll save them for a follow-up episode. For today, I just have one. How do you think about success? It's a personal question I ask all my guests to close our conversation. What's your definition of success?
It's an interesting question. I mean, the sleep at night bit is kind of important. Decision-making under conditions of uncertainty. So I left the cave of academia. The cave of academia was safe, but very modest in terms of its protein. If you wanted protein, you had to leave the cave and go find a woolly mammoth or a saber-toothed tiger. So decision-making under conditions of uncertainty. Can you manage that in a way that's satisfying? Who you marry, what job you do, where you live, how you interact with other people. Do you cross the street? What do you order for a sandwich? Do you buy insurance? Do you rent? Do you buy? Do you get the flashy car? Do you get the Honda? All of those are decision-making under conditions of uncertainty with various implications. And I spent a lot of time thinking about that. And, it's one of those things as in kind of not particularly meaningful generalities that if you get 50.05% of those questions right, then you've probably been successful. It's hard to get much more than that correct. But I think that one measure of that is how comfortable are you in your skin, what you're doing? Are you constantly worrying? Or do you like what you do and, how you do it? And, that I think is a measure of success. And for each person, it will not be risk-adjusted total return. It will be an individualized relative total return. It'll be an individualized solution, the sleep at night. And so, I'd like to think, I've been told that clients who invest in this fashion understand exactly what they're giving up, which is the rocket ship, the straight up tech companies and so forth. They know what they're missing because they know what they're getting, and they're content with that. They're able to sleep at night with that because they're tangible assets, cash returns. And that, if the clients are sleeping at night, then I would consider it a success. And again, it's not really the University of Chicago definition of success. It's more a Main Street definition of success. There's a story in the book, which you may remember, with Joseph Heller and Kurt Vonnegut. And for those of you, audience maybe a little bit younger, Kurt Vonnegut, famous writer, many different books. Joseph Heller is the author of Catch-22, a famous novel after World War II, written about World War II. But Catch-22 is really one, kind of a candidate for the great American novel. It's not the great American novel, but it's there. And Kurt Vonnegut, a very prominent writer. And there's an appreciation by Kurt Vonnegut that was in the New Yorker 20, 30 years ago. I think after Joseph Heller had died, he's telling a story about, 2015. He's telling a story about Joseph Heller. Vonnegut and Heller were invited to somebody's party, shishi event on the Hamptons. And I have to remember to get this story correct. And Kurt Vonnegut says to Joseph Heller, "Don't you kind of feel jealous? This guy, makes more in a day than you'll ever make in your lifetime." And Joseph Heller responds to Kurt Vonnegut, saying, "Yeah, but I have something that he'll never have. I know when is enough. I have enough. I know when I have enough," something to that effect. And that's not how modern finance is taught, but that's a measure of success. Joseph Heller would sleep at night. He knew he had enough. He knew what he was about, and he knew he had enough. I do feel for the people running around the canyons of Wall Street, many of them in New York, you read about them. I hope you're not one of them, Bogomil, but they don't appear to know what is enough, and I don't think they sleep very well. Highly judgmental of me. I apologize if you're offended, but I think there are more people who would know themselves. To thine own self be true. Again, it's Shakespeare. Polonius plays the fool, but Polonius's speech to Laertes is about as good an education and investment as you can possibly get. And so I think that measure of sleeping at night for the clients, for myself, and being true to yourself is a very good kind of measure of success. I still primarily identify as a historian, and I now, in this career of finance, I operate substantially in line with how I identify, and I think that works for me.
I love the sound of that, and I like the idea of quality of sleep, and I write about it too, and I share it with clients. If I can sleep well at night and they can sleep well at night, I accomplish something, one of the parts of the success that I have in mind. Then this was such a wonderful conversation. Thank you so much. Wonderful book, wonderful thoughts, and I think maybe we'll inspire some ideas among the audience to think about investing in a different way. Then, thank you so much for today.
Thank you, Bogomil, for having me on. It was I enjoyed the conversation as well.
You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. If you enjoyed the show, please take a moment and follow, subscribe, rate, and share with friends and family. We rely on word of mouth to promote the show. One click for you means the world to us. Thank you. Until next time, your host, Bogomil Baranowski.